$10 million from 100 grand. Sounds impossible, right? Well, it's not. And the path to get there is hiding in plain sight. Look, you've probably heard that you need millions in the bank to even think about getting into the serious real estate game. That to buy apartment buildings and create real generational wealth, you have to already be wealthy. Yeah, that's a total myth. Today, I'm breaking down the exact 5-step blueprint that savvy investors use to turn a starting capital of just $100,000 into a wealth-building machine. We're going to follow a real-world case study from the first dollar invested to the final $10 million portfolio. So forget everything you think you know, and let's get to building. Hey everyone, I'm Ryan. On this channel, we don't chase money, we build systems that generate it. I break down real wealth strategies, asset building frameworks, and financial truths most people never learn. If you're serious about growing your money the smart way, subscribe now and hit the bell icon. Let's build something that pays you back. The journey to 10 million bucks doesn't start with a skyscraper. It starts with one smart, calculated move. This is step 1, laying the foundation with your first small multifamily property. Most people with $100,000 in savings either let it get eaten by inflation in the bank or gamble it on some speculative stock. A strategic investor does neither. They use it as a tool. Your goal isn't to buy your dream home. It's to buy a cash-flowing asset. With $100,000, you can realistically make a 20 to 25% down payment on a property in the $400,000 to $500,000 range. Now, we're not talking about a single-family home. We're talking about a duplex, a triplex, or even a fourplex. Why? Because from day one, you have multiple rent checks coming in, which helps cover your mortgage and other costs. You'll need a solid credit score, usually 680 or higher, but this is totally achievable. But here's the secret sauce. You don't buy a perfect, polished property. You hunt for something with a flaw. You look for the value-add opportunity. This is a building that's got good bones, but is cosmetically stuck in the past, with rents way below what they should be. Maybe the kitchens are straight out of the 80s, the carpets have seen better days, and the landlord just hasn't bothered to raise rents in a decade. This isn't a problem. This is a gold mine. Let's meet our case study investor, Alex. Alex has $100,000 saved up. After a 2-month search, Alex finds a duplex for $400,000. It needs some love, and the rents are only $1,200 per unit, when renovated places nearby are getting $1,800. Alex puts the $100,000 down, securing a loan for the other $300,000. The first domino has just fallen. So, Alex has the keys. Now what? This is where the real work starts. Step 2 is all about forcing appreciation. This is what separates the casual landlord from a true wealth builder. You don't sit back and wait for the market to give you value. You go out and create it yourself. Forcing appreciation just means cranking up the property's net operating income, or NOI. Think of NOI like this. It's all the money the property makes minus all the day-to-day expenses to run it. The higher your NOI, the more your property is worth to a bank or a future buyer. It's that simple. So, here's Alex's game plan. A tenant moves out, creating the perfect opening. Alex goes in and strategically invests about $15,000 into that unit. Fresh paint, new flooring, a modernized kitchen with new countertops and appliances, and updated bathroom fixtures. It's not a gut renovation. It's a cosmetic facelift with a high return on investment. Once it's done, it's no longer a $1,200 a month unit. Alex lists it and immediately rents it for the full market rate of $1,800. Boom! That's a $600 monthly increase. When the second tenant's lease is up, Alex does the exact same thing to the other unit. The property's total monthly rent just jumped from $2,400 to $3,600. That's an extra $14,400 in gross income every year. Because commercial properties are valued based on their income, Alex has literally forced the value of the duplex to go up. A year and a half after buying it for $400,000, a new appraisal comes in. The property is now worth $550,000. Alex created $150,000 in new value through pure strategy, not luck. This next step is the absolute key. It's the engine that will power this whole journey. Step 3 is leveraging the 1031 exchange. If Alex just sold the duplex for $550,000, a huge chunk of that profit would get eaten up by capital gains taxes. This is the trap that kills momentum for most people. They sell, pay 30% to the government, and their snowball melts. But the 1031 exchange, named after Section 1031 of the IRS code, is your legal loophole. It lets you defer paying those taxes, as long as you roll the proceeds into a similar, like-kind investment property. There are some strict rules. You have to identify your new property within 45 days of selling the old one, and you have to close on it within 180 days. Crucially, to defer all times the taxes, you have to buy a property of equal or greater value and reinvest all times the cash proceeds from the sale. So, Alex sells the duplex for $550,000. After paying off the remaining mortgage, around $290,000, Alex is left with about $260,000 in equity. Instead of watching taxes gobble it up, Alex initiates a 1031 exchange. That entire $260,000 is now ready to be fired into a much bigger deal, completely tax-deferred. If the gears are starting to turn and you're seeing how powerful this is, do me a favor and hit that like button. It tells the YouTube algorithm that you're getting value, and that helps more people find this blueprint. With a tax-deferred war chest of over $250,000, Alex isn't in the minor leagues anymore. Welcome to Step 4, scaling into true commercial multifamily. That duplex was just the training wheels. It's time to buy an apartment building. That $260,000 in equity is a hefty down payment for a much larger asset. Alex starts hunting for a 10 to 20 unit building, another value-add deal, of course. After a good search, Alex finds a 15 unit apartment building for $1.2 million. It's run by a tired landlord. The units are dated, and the rents are, you guessed it, way below market. The $260,000 from the 1031 exchange is more than enough for the down payment. Alex gets a commercial loan, maybe even a short-term bridge loan designed to fund both the purchase and the renovations. And now, Alex just runs the same play, but on a much bigger field. Over the next couple of years, as leases expire, Alex renovates units one by one, bringing them up to modern standards and bumping the rents to match. A professional property manager is hired to streamline everything. By executing this plan across 15 units, the jump in net operating income is massive. 2 years after buying it for $1.2 million, the spruced-up, stabilized building gets a new appraisal. It's now worth $2 million. Alex's equity has exploded from that $260,000 rollover to nearly $1 million, all while the property was spitting out cash flow. You've built the money machine. Now it's time to let it run. Step 5 is about creating a snowball effect. You rinse, repeat, and optimize the process. Alex now sells the 15 unit building for $2 million, and of course, launches another 1031 exchange. After paying off the loan, Alex is now rolling forward, almost $1 million in equity, all of it grown tax-deferred. This is the kind of capital that gets you a serious seat at the investment table. With this kind of equity, Alex can hunt for even bigger fish, 30 units, 50 units, even 100 units. Alex might even partner with another investor in a joint venture to take down a $5 million plus property, scaling even faster. And here's where you can bring in some really powerful tools, like cost segregation. This is a sophisticated tax strategy where engineers analyze your building and accelerate the depreciation of certain components. Things like carpets, appliances, and fixtures. Instead of depreciating everything over 27.5 years, big chunks can be written off over 5 or 15 years. This creates huge paper losses that can significantly reduce your taxable income. While it doesn't make income permanently tax-free, these deductions can offset your cash flow, meaning you could potentially pay zero taxes on your rental income for several years, keeping more cash in your pocket to fuel the next deal. Following this blueprint, Alex does one more 1,031 exchange, rolling that equity into a 7.5-unit complex. A few years of improvements later, Alex's share of the portfolio is valued at over $10 million. Mission accomplished. So let's recap the 5 steps. 1. You start smart with a small, value-add multifamily property. 2. You force the appreciation yourself by renovating and raising rents, creating value out of thin air. 3. You use the 1,031 exchange as your secret weapon, deferring taxes so 100% of your money stays in the game. 4. You scale up using that bigger equity to buy actual apartment buildings. And 5. You rinse and repeat, creating a snowball of wealth and using advanced strategies to optimize your returns. This isn't a get-rich-quick scheme. This took Alex nearly a decade of discipline and strategy, and it's important to know that market cycles and lending conditions can affect that timeline. But it didn't take millions to start. It took $100,000 and a proven blueprint. It took education, a great team, and the guts to take that first step. This path is open to anyone willing to learn the rules and play the long game. That dream of generational wealth, it isn't nearly as far away as you might think. Now you have the blueprint. But knowing the path is different from walking the path. The most important step is always the next one. So, I want to hear from you. Comment below with the single biggest thing you feel is holding you back from your first or next real estate deal. I'll be in the comments, replying to as many as I can to help you get unstuck. Let's build this together.